This morning, Morgan Stanley has officially joined the Cut Rates Now choir. The brokerage now expects the Federal Reserve to slice interest rates in September because apparently Jerome Powell went to Jackson Hole, looked at the labor market, and decided that unemployment finally matters more than inflation. Morgan Stanley says Powell's tone marked a real pivot. This is the same Fed chair who couldn't stop lecturing everyone about inflation persistence and how the job market was too strong. Now, well, he's suddenly worried about downside risks for workers. And the street heard it loud and clear. Morgan Stanley now forecasts 225 basis point cuts this year, one in September and another in December. That's a big shift from their old forecast, which assumed no cuts until March of 2026. We got to get an exterminator, but we're bringing André back because we want to talk about this story. So André, thank you for your patience on that one. I apologize. But let's get to the news here. Morgan Stanley, they now think that we're going to be getting 2 rate cuts this year and then steady trims throughout 2026. Do you think this is the Fed's way of actually pivoting, or is this Jerome Powell realizing that unemployment is a little less fun when it's real people and not just a chart that he looks at? What do you think?
So, since the Fed started cutting rates, we have to look back what happened already, right? The Fed already started cutting rates in September, right? They delivered 3 rate cuts, but then they paused in December, right? For whatever reason, right? There might be political reasons, whatever, right? But they just paused. That's just a fact, right? And meanwhile, we've actually seen that both inflation and labor market data in the US have actually deteriorated even more, right? Labor market data surprises, inflation data surprises have continued to surprise to the downside, right? Apart from the most recent producer price inflation data print, but overall, if you take a bunch of the major data releases, inflation and labor market data release, they've continued to surprise to the downside. So the case for further rate cuts since December, since the Fed actually paused cutting rates, has actually strengthened even more. So my personal base case is, or my personal thesis is, the Fed remains behind the curve. And if you take a standard Taylor rule that just looks at U3 unemployment rate and core inflation, right? I think the Fed funds target rate should be around 50 basis points lower than today. So they definitely need to do something, in my view. And talk about the outlook for employment data and inflation data. You can make the case that headline inflation is moving up because of tariffs, right? Because of base effects and so on. There's some drag from housing, from rents, and so core inflation data are actually still decelerating. But if you look at leading employment data, they actually suggest that the labor market is still weakening, right? So if you look at the spread between jobs plentiful minus jobs hard to get in the Conference Board survey, consumer survey, it actually suggests that the employment rate will likely continue to move up, right? And so I think if the Fed is now focusing on labor market data instead of is focusing more on labor market data instead of inflation data, I think the case for more rate cuts will even strengthen in September and beyond.
Yeah. Donald Trump has been calling him too late Powell for a reason, so it sounds like he's finally getting on board the train here. And as you and I know, for Bitcoin, cheaper money is basically confetti falling from the ceiling. Do you think a new easing cycle turbocharges Bitcoin's hard money narrative more than in the past?
I think it does because of the following reasons. So why are Fed rate cuts even important for Bitcoin? Right? The mechanism, or the transmission mechanism, how it usually works is, so the Fed can control the short end of the yield curve, right? Of the interest rate curve. So the moment they start cutting rates, what usually happens, you see a steepening in the yield curve, right? And this usually tends to incentivize bank lending and money supply growth. So money supply growth usually accelerates with the steepening of the yield curve. And we know Bitcoin likes higher money supply growth, higher monetary debasement, right? And we also know like global
Right.
money supply is already at all-time highs, right? We know Chinese money supply is accelerating. We know US money supply growth already accelerating. If the Fed continues cutting rates, even more so. And I think that case, yeah, that strengthened the bullish case for Bitcoin from a pure macro perspective. And so, yeah, I think it's bullish for Bitcoin.
Yeah, absolutely. I mean, if the Fed keeps cutting rates into 2026, we could be down back around that 3% mark. And if that were the case, do you feel like we're setting up for a multi year liquidity wave that cements Bitcoin as kind of the ultimate macro hedge?
So what we've seen so far is we've seen this expansion in global money supply, right? We've seen new all-time highs despite this Fed pause and so on, right? But what happened in the meantime, since the Fed stopped cutting rates in December, is like the ECB delivered more rate cuts, right? The European Central Bank, the Bank of England delivered more rate cuts. Swiss National Bank, one of the major central banks in the world, delivered more rate cuts, right? And continued to ease monetary policy. And what we've seen is so this increase in global money supply, but also if you look at the aggregate number of rate cuts over the past 12 months, right, across the globe, it's the highest it's ever since subprime, essentially. So since 2009, apart from COVID, of course, where you had like the highest monetary stimulus. But apart from COVID, we have seen the highest number of rate cuts globally and also the strongest acceleration in liquidity growth. So I think it's setting up Bitcoin for a multi-year run potentially because what we're seeing in the data is that actually supply factors like the halving deficit, right? That deficit induced by the halving, which is around 164,000 Bitcoins per year, is becoming less important, while demand factors by ETPs, Bitcoin treasury companies, and so on is actually outsizing this effect by a very wide margin, right? It's around 5 times bigger, right? And if you so what influences this kind of demand factor? It's the macro cycle. And if you assume that like the macro cycle, the business cycle is rather at the beginning than the end, right? Because the Fed continues to cut rates and so on, which tends to prolong a business cycle, right? So I think we're probably rather looking at an extension of the bull run than a cycle top, because I think the majority of analysts still believes we'll see the cycle top in Bitcoin over the next 2 to 3 months based on like historical
Mm-hmm.
patterns. But I think we'll probably see a break of this pattern because the macro cycle and the institutional demand cycle is becoming increasingly more important.
Yeah, and I mean, I think that's been echoed by your CIO, Matt Hogan, who was on the show, and he mentioned that he thinks that the cycles as we've known them in the past are kind of going to be a thing of the past. We have all this institutional money in the market now. We have governments jumping
Mm.
in and testing the waters in Bitcoin. So, are you in agreement that we're at this new phase or inflection point of Bitcoin's maturation process where cycles are going to be kind of a thing of the past and there's going to be a lot of other factors at play that determine Bitcoin's price rather than just these 4 year halving cycles? I mean, the majority of Bitcoin that will ever be available has almost already been mined.
Exactly. And I think that's the big difference between today and like 2012 or 2016. Like if you consider the size of the halving deficit relative to supply, for instance, during the first halving, right, which was in 2012, right? So the first halving saw a reduction in supply per block of 25 Bitcoins, which was around, I think, 12.5% of the existing supply, right, back then, because you only had 10 million coins. And that relative
Right.
supply shock induced by the halving has actually declined over time with every new halving since 2012, right? And if you look at the very last halving, the latest halving in 2024, the reduction supply per block was 3.125 Bitcoin, right? which is less than 1% relative to the existing supply and circulation. So that effect is
Yeah.
actually relative to the existing supply is becoming less and less important. And that's why the halving effect is becoming less important. And it's probably also the reason why we've seen these diminishing returns each cycle, because like the halving effect is becoming like less important. But what we've seen, especially since 2024, since the onset of spot Bitcoin ETFs, um, we saw new all-time highs before the halving, which was unprecedented. And I think that alone speaks volumes in terms of like the shifting dominance, right? So we're seeing this kind of shifting dominance from supply factors, halving, let's say, to demand factors, right? To institutional demand,
Hmm.
ETPs, ETFs, right? That have been by a magnitude higher than the supply deficit. And so, yes, I think that's the harming itself is definitely becoming less important.
All right, beautiful. We'll have to make sure to check that out ourselves. And Andre, we do one thing at the end of this show before we let you go, is we are keeping a up-to-date chart of everybody's Bitcoin price predictions for the very end of this year. This is not any kind of financial advice. This is just your thoughts as an expert in this space. What do you think that Bitcoin will be at by the end of 2025? What's your guess? We're going to put it on a board and revisit it next time we have you back on the show. So what are your thoughts? And give us a little bit of a
So
why, if you
base
don't mind.
case is 200K dollars by the end
Okay.
of the year. The reason is like from a pure seasonality perspective, Q4 is the strongest quarter, performance quarter for Bitcoin. So I mean,
Mm-hmm.
August, September, on the other hand, they're one of the worst month for Bitcoin performance wise. So there's not much happening in August and September anyway, but like Q4 is tends to be the strongest quarter. So I'd expect Bitcoin to rally in Q4. And one of the key reasons is probably the 401k executive order, which is unleashing a huge amount of capital. I mean, if you even take tiny percentages of like the current assets under management in 401ks and other defined contribution plans in the US, like that 12.2 trillion assets in 401ks and other defined contribution plans. And even if you take like 1% of that amount and which is substituted with Bitcoin ETFs, you will end up with $122 billion, which is a significant amount for the whole Bitcoin ETP market globally. It's around 63% of like global Bitcoin ETP assets. And based on historical relationships, like a 1% increase in global Bitcoin ETP AUM, assets under management, is roughly associated with a 1% performance in Bitcoin. So even by this, like by a very tiny reallocation of these 401ks and other retirement plans, you'll see that Bitcoin will probably approach 200K. But if you assume that we'll see a continuation of the Fed's rate cutting cycle, even more so, right? So yeah.
200K. Okay, so that's your base case. Now I want you to give me an exact number. And mind you, we're having other people do this as well. And whoever wins it, I'm sending them a Roxom Patagonia. So we had yesterday, for instance, we had someone try to price us right at, they said $200,001. Do you want to stay at 200K or do you want to revise it to something a little bit different? I don't want you to get trapped.
So official prediction is 200K, but I'd say probably a bit more conservative. I'd say 172.